This is our topic 4 for our financial curriculum, types of funding for startups. There are two types of funding, dilutive equity financing and non-dilutive financing. Dilutive financing includes equity and debt convertible into equity or convertible notes. Non-dilutive financing includes debt or loans, crowdfunding, grants or FDIs, customer advance payments, and supply line of credit. Now we'll further talk about the types of funding, dilutive and non-dilutive funding. Dilutive or equity financing, also known as equity financing, is any kind of funding that requires you to give up ownership of your company. When you forfeit partial ownership to an investor, not only are you forfeiting a portion of your future profits, but you may also be forfeiting some of your own control over the direction and actions of the business as well. An example of dilutive financing would be selling shares to an angel investor or venture capitalist. Now, moving forward towards a second type of funding, non dilutive fundings. They're any kind of funding that does not require you to give away a piece of your company. So you get to maintain 100% control over the ownership and decision making power of the company. Options of non dilutive includes loans, grants, licensing, and tax credits. Recent trends are seeing more revenue sharing models which can take a percentage of a company's monthly revenue until the investment is paid back. Loans are available from institutions, government agencies, and banks. With all options, founders are able to maintain 100% ownership and control over the entire company, providing them with more autonomy than dilutive funding options. Moving forward towards discussing the more forms of dilutive equity financing. Equity financing received from angel investors or venture capitalist firms through equity sharing or convertible notes. Convertible notes are when the promised debt can't be paid back to an investor and the debt is converted into the ownership of the company. It can be partial or through any shares. An investor is someone who gives money to a business for the purpose of operating. The most coveted type of investor is an angel investor. An angel investor provides funds from their own company or personal accounts. Angel investors typically expect a partial or full ownership stake in the company. Usually, they receive a payout based on the company's performance. Moving forward towards the continued dilutive equity financing. Venture capital is a type of private equity that is typically used to finance early stage companies and startups. It comes from well off investors and usually involves a variety of financial institutions. This funding is used to help the company reach a wider market. Unlike startup financing options, a VC requires a company's equity in exchange for the money it gives. If you're comfortable with having to share some of your earnings with someone else, a VC firm may be able to provide funding in a time of need. Now moving forward towards the type of non-dilutive financing, a debt or a loan. A small business loan is typically secured by a business or personal loan. You may have to provide collateral or have a high credit score in order to get it approved. Unlike usual bank loans, a microloan is not very secured. They can be offered to individuals with little or no credit history. The interest rates vary a lot, from very high to quite low one as well, depending on the feasibility of the firm or the startup. There are plenty of advantages to getting a loan, but there are also some downsides to it. Besides owning money, founders have to account for how having loans may negatively impact their ability to fundraise in their own ways. When talking about more forms of non-dilutive financing, crowdfunding or platform or Kickstarters are one of the best ways to do it. A crowdfunding campaign is an online platform where people can give money to a company. In some cases, the crowdfunders exchange their money for an early product or a service launch. Crowdfunding is a growing industry. There are a number of platforms that will allow you to raise funds for their projects. Each platform has its own unique perks. Platforms like Kickstarters allow companies to raise funds without having to pay for the platform or provide rewards. Equity crowdfunding is also a type of crowdfunding that allows backers to own a portion of a company. Crowdfunding is generally low risk. However, a failed campaign can cost you time and money. Talking about one of the best ways of a non-dilutive financing is grants and FDIs. Unlike loans, grants are not required to be repaid. They are highly competitive and can provide immediate cash to boost your business. Getting a small business grant can be challenging, but it can be worth it in the long run. There are numerous grants available to help small businesses, many of which can be found through industry associations and organizations. The final two modes of non-dilutive financings are customer advance payments and supply line of credit. A customer advance payment are taking payments in advance of selling products, services to customers. It can be an early form of subscriptions. Supply line of credit is the practice of selling a company's invoice or accounts receivable in exchange for cash in advance.